Well, it has been a notable week for earnings, including from Scotiabank, the Canadian lender reporting adjusted profits that topped Bay Street estimates. Now, beyond navigating the current economic landscape, Scotia has been busy executing on a plan to focus more on the Canadian market as well as the U.S., while shifting some capital from Latin America. Joining us in studio with an update on all of that is the executive leading that charge, Scott Thompson, who is Scotiabank's president and CEO. And Scott, it's great to see you again. Thanks for the time.
Thanks for having me, John.
So obviously a busy time, lots of earnings, including out of your sector. Let's start with the performance at Scotia itself. How would you describe the quarter?
I thought it was a good quarter. We did what we said we were going to do for the fifth quarter in a row. We increased ROE, return on equity, which is an important metric for our shareholders, by about 120 basis points. And importantly, as we move the bank from a volume-led approach to a value-led approach, seeing fee income grow up 15% year over year was encouraging. Business line by business line, our capital markets business was up 50%. The GBM business, as a result, was up 33% year over year. Wealth was up 22%. And our international bank had its second best quarter ever. And so, improvements in all those three areas. And in Canada, we saw improvement in deposits and improvement in primary clients. So as we laid out at the strategy refresh December of a year ago, starting to make progress in all these areas.
Well, you've been tackling a lot. Let's just talk for Canada for a second as an example, because you were talking about that last time we spoke, and you highlighted we saw some evidence there in a number of Canadian units, including wealth. How do you go about making that transition to grow more in Canada? What has been top of mind for you with that?
Yeah, well, as we said, Canada was the first port of call for capital, and we've on that journey. And it's about the North Star of primary clients, making sure we get primary clients. And we saw some encouraging signs this quarter. So our commercial business, with no extra capital deployed, actually saw its best quarter ever from a pre-tax, pre-provision basis. Our wealth business saw 50% improvement in fund sales, mutual fund sales. And Scene+, which we think is a competitive advantage for us. It's a great loyalty program, 15 million members. 25% of those members are now Scotiabank primary clients with payment product. So good momentum in terms of moving towards the primacy objective for our clients.
Okay, so a lot of focus on Canada, but as we mentioned, you've been busy beyond the Canadian border. There was the acquisition of nearly 15% of KeyCorp, which is a Cleveland-based lender. You've transferred some of your Latin American assets to a leading Colombian bank. Can you walk us through those moving parts for those who are maybe less familiar with this process you're going through right now?
Sure. What we highlighted in the strategy refresh was a redeployment of capital from developing markets to developed markets, with a focus on the North American corridor. Canada first, U.S. second, Mexico third. And so when you think about those two strategic moves that we announced this quarter, the KeyCorp acquisition, we'll see about $400 million of net income contribution going forward from that acquisition. It was primarily a financial transaction because we had excess capital, and so redeploying it into a minority stake in a regional lender in the U.S. will allow us to have a very attractive return on capital relative to a share repurchase. And then with Colombia, we saw the merger of our assets in Panama, Costa Rica, and Colombia into the second largest bank in Colombia. And we had a lot of discussion on whether we should sell or redeploy into the second biggest lender. And the objective here was to do what's right for shareholders. And so selling full stop in an environment where it's very depressed, we thought it would be better to take a accretive approach from a capital perspective and an earnings perspective, and then look for a better time to sell when the markets recover. So that was the thinking behind the Colombia acquisition. So
these are all, I guess I would say, tangibles. The intangible right now, which I'm sure you get a lot of questions around, is the uncertainty in the air. Mm-hmm. So how do you navigate uncertainty? How do you prepare for uncertainty? What are you thinking about these days?
What I say to the team is just control what you can. And we can't control what's coming out of the White House. But what you can control is your costs. You can control your capital deployment. You can run the bank a little bit more conservatively. And it's definitely an uncertain time. And when you have an uncertain time, you see a little bit of less capital deployment on behalf of our clients. But the encouraging sign is you see more opportunities for advisory businesses. And so in a relationship-based business, making sure you're out in front of your clients, helping them navigate an uncertain scenario is what we're trying to do right now. And you actually saw that show up in the numbers. And so our advisory business, the Global Banking and Markets business, was up, as I said, 33% year over year. So good focus on communicating with clients to help them through this uncertain period.
You know, it's interesting when we think about how the world is shifting. When we last talked, we talked about the benefits of having an integrated North American economy, and you have this presence in Canada and the United States and Mexico. And you were asked on the conference call by analysts, you know, how you feel about that strategy in light of the current situation. You said you're committed to. Can you walk us through how you're thinking about it?
Yeah, so for context, 50% of our earnings come from Canada, about 15% come from the US, and less than 10% come from Mexico. And as we said in our Investor Day, Canada was the first port of call for capital, US second, and Mexico third. And when you look at the numbers this quarter, we actually saw our US business up 39% year over year. We've been very hesitant on deploying capital into Mexico until we understand what the new administration is going to do, and also how the USMCA negotiations come out. But the reality is you have $1.6 trillion of trade flows across these three countries. And if US is to achieve its geopolitical ambitions, I think resources in Canada and the labor availability in Mexico are going to be important. And so for us to have a place in all three of these countries is going to be an important strategic objective for us going forward.
So when we were talking earlier about Canada, it sounded to me like you were saying just focusing on a market allows the team to give customers a little bit more of what they might need regardless of capital flows. So I guess in light of the situation right now, and you've got customers across North America, what are the client needs? What are people asking about? What are they leaning on you for right now?
Yeah, so as an example this quarter, I mean, we took a couple of our big Canadian clients to market in the US. So we led a big debt offering for Rogers. We led a big debt offering for CNRL. We're advising some of our resource-based companies actually in the US about their assets in Canada. So we were the lead advisor for Chevron as they sold their Duvernay assets to CNRL. And then we were also a lead advisor to LS Power as they bought the renewables business from Algonquin. And that was both a Canadian and a US. So it's, again, a move to advisory as opposed to just loan and balance sheet. Because in an uncertain period like this is what our clients need. Is they need that advice and relationship-based approach from our bank.
You know, it's interesting, and this is probably true for a lot of those clients too. There's the one piece of uncertainty that comes from political or policy dynamics, but then interest rate policy feeds into that, I suppose, depending on how those other parts play out. What is the current thinking from you and the Scotia Economics team on what happens on the interest rate front?
Yeah, I mean, we're preparing for higher for longer. So as you think about the U.S. Fed, you know, the rate's around 4.5% right now. I think we would view the terminal rate as being 3.5%, but to get from 4.5 to 3.5% is going to take some time. So probably another 50 basis points this year, and then 50 more basis points in 2025, or sorry, 2026. And that's all dependent on how the tariffs play out in terms of inflation. And if you have an inflationary environment, obviously the Fed's ability to move rates down is going to be hampered a little bit. In Canada, they've already made a pretty significant move down.
Yeah.
And so we are expecting another 25 basis points move down by the Bank of Canada. But it's a difficult situation for the Bank of Canada to be in because they have the pending view of tariffs coming in, which would obviously weaken the Canadian economy. They would typically then reduce rates, but in an environment where you're looking at retaliatory tariffs, that actually could be inflationary. And then in that environment, you're going to be hesitant to reduce rates. And so I think for now, the Bank of Canada is probably stuck about where it is. A little bit more rate reduction, but not too much.
So in terms of running your business, the other consideration is how much you have to prepare for the possibility of bad loans, credit provisioning. And I think you talked about provisioning at elevated levels right now. How do you determine what those levels look like going forward? Again, because we seem to be working with some known uncertainty, but it's still kind of an intangible issue.
Yeah, well, the interesting thing is prior to 30 days ago, the Canadian economy was looking a little bit better. And so the rate reductions that had come in from the Bank of Canada were having an impact. And you think about the Canadian economy, it is pretty rate sensitive.
Yeah.
So when rates come down, the economy starts to pick up. And so we were expecting a better year in 2025 as provisions come down. Now, in the first quarter, we built provisions a little bit because of this uncertainty on tariffs. And so you saw about $100 million performing build for us in preparation for the potential of tariffs. If tariffs don't come to fruition, then I think we'll see a better back half of the year in terms of provision as the economy gets a little bit better. If tariffs do come in, then of course we'll have to rethink how we approach provisions in light of an economy that's going to slow.
All right. Well, those are all the things you have to think about minute by minute in running a business. But as a country, we're trying to navigate where we go from here. And a lot of people are looking at the opportunity in this uncertainty. If there's an opportunity right now to have a conversation about where Canada's economy goes from here, where do you weigh in on that right now?
Well, I mean, the good news in all of this is we're going to have an election at some point with two parties that have pro-growth agendas. And that's really important because over the last 10 years as a country, we've really stumbled on this productivity gap between Canada and the US. And so what we're trying to encourage both parties to think about is lower taxes, lower regulation, incentives for investment, trying to get our resources out of the ground and to markets. In the case of oil and gas, to export markets. In the case of the rest of the natural resources, just to markets. And if we can do that, we will actually be in a much better outcome 10 years from now than where we are today.
Are you positive are you hopeful about us being able to deliver on that?
I am, because I think there's been a change in the tone in Canada over the last 2 or 3 months, recognizing the challenge we're in, but the opportunity that we do have. We've got a great population, talented population base. We've got a great resource profile. We haven't capitalized on that resource base that we have, and we need to do that. The obvious one is oil and gas, and now the debate around pipelines has changed dramatically. You hear people talking about Northern Gateway, you hear people talking about Energy East, you hear people talking about the second phase of LNG. And so if we can do that for not only oil and gas, but the rest of our resource base as well, I think Canada will be in a great place going forward.
All right, Scott, we appreciate the time. Thanks very much for stopping by today.
Thanks for having me.
Scott